A form of long-term debt that is unique to corporations is bonds. I mean, anybody can go out and take a loan from the bank. Anybody can go and sign a mortgage. But bonds are selling your debt specifically to investors. So instead of going to a place that typically does borrowing, a bank, etc., you are going to the public and saying, hey, we need to borrow some money. Would you like to let us borrow some money? And each bond that you have has a value associated with it called the face value. And it is the amount that you are borrowing up front that you agree to repay down the road. And face value has many synonymous terms: maturity value, principal amount, par value. They're all the same thing. They are the stated rate on the bond, the stated amount on the bond, that you are borrowing in the beginning that you agree to repay once the bond's life ends and it becomes mature and therefore due. Speaking of becoming mature, the maturity date is the date on the bond when that repayment has to be made. And bonds come in various different lengths. There are 1-year bonds, 2-year bonds, 5-year bonds, 10-year bonds, 20-year bonds. Whatever the number of years associated with the bond is its date of its maturity. And until that maturity date rolls around and you have to repay the principal that you borrowed up front, you are going to make a series of periodic interest payments to your bond holders. So each bond not only has a face rate or a face value associated with it, it has a stated rate, which is the amount of interest that you pay periodically on that bond. And the term stated rate, face rate, coupon rates, and nominal rates are all synonymous, but I will try to do my best to stick with the term stated rate. I do, however, find the term coupon rate to be kind of entertaining. Back in the day, before computerized technology was a thing, when you bought a bond, when you borrowed from a corporation, or when you let a corporation borrow from you, they would give you the bond, and there were little tabs on the bottom, and you would have to pull off the tab, go to the corporate headquarters, hand it over to them, and they would hand you your interest payment for the period. That's how the term coupon rate started. You had to literally tear a coupon off of the bond and take it to the bond issuer to get your money. Thank God those days are not around anymore, but for a while, coupon rate was the going term. Much more commonly nowadays, you hear the term stated or face rate on a bond. Bonds come in various different types. Two distinctions that you can have are term bonds and serial bonds. And what that is a grouping of maturity dates. If they are term bonds, you are issuing one set of bonds that all have the same maturity date. So you would be issuing out just a ton of 5-year bonds. And the only problem with that is at the end of those 5 years, all of a sudden you have to repay all of that principal at once, and that is a massive liability becoming due on your books, which can be scary when you have that debt payment coming up of that huge portion. So companies will sometimes issue serial bonds. And serial bonds, instead of issuing all 5-year bonds, they would issue some 1-year bonds, some 2-year bonds, some 3-year bonds. They're basically staggering their bond payments, their repayment of that face value, over a period of time. So they don't have that one big liability down the road. They instead have a series of smaller liabilities that they have to pay off. Another delineator between bonds is secured bonds versus debentures. A secured bond is a bond that has a guarantee tied to it. If that maturity date rolls around and your company is obligated to repay the principal to your bondholders, and you don't have the cash to do so, well, if it's a secure bond, you have to give them something else instead. And that something else is usually common stock. So if a bond is secured and your company is unable to make its repayment at the end of the bond's life, you would instead transfer common stock with market value equal to the face value of the bond. A debenture is a bond that doesn't have any backing, which means if the maturity date rolls around and you don't have the money to pay back your bondholders, oh well, tough luck for them. They don't get the repayment of their principal, and then they're commonly referred to as junk bonds as well. So debentures are much more risky for bondholders. They're much riskier to your investors because they know they're not going to guarantee to get anything at the end of the bond's life, which means if you're the company issuing debentures, you have to pay a much higher amount of interest each time on your bond to entice people to want to invest in them in the first place. If you're securing it via secured bonds, you can get away with a much lower stated interest rate. And on this graph right here, we have a series of how the payments would flow out from a company that issued a bond. So in this case, we have a 5-year 9% bond issued at a face value of $100,000 on January 1st, 2018. Well, the very first thing we have over here on the left is that on January 1st, 2018, we are going to receive $100,000 from the people investing in our bonds. Over the life of the bond, we have to make a series of periodic interest payments to our bond holders, and it's found by using the interest formula you always use, which for a bond is face times rate times time. So the face is 100,000, stated rate is 9%, and we're making semi-annual payments, so time is going to be 6 out of 12, half of the year, 6 months out of 12 months, and when we multiply that out, we come out with $4,500. Which means for the entire life of this bond, we are going to have to pay our bondholders $4,500 every 6 months. And as you can see down here from our schedule, it's exactly what's happening. Every 6 months, we have a cash outflow of $4,500 going to our bond holders. And then once the bond becomes mature, and it's a 5-year bond, so from January 1st, 2018 till December 31st, 2022, 5 years have passed. At the end of that, we need to repay the face value of the bond. So in this case, we would pay that $100,000 back to our bond holders. Bonds can be issued at different what they call bond prices. Bonds need to be authorized, just like stock does, by your board of directors. And when you get these bonds authorized, the board of directors will say you can issue these bonds at this set stated rate, 5%, 6%, 7%, whatever. And once they've approved of them, it means you don't have to issue them. You'll have the right to reserve future bonds going forward. But the problem with that is that rate, that stated rate that's competitive on bonds, is always going up and down. And by that I mean you could have your board of directors approve 5% bonds, and you haven't issued them yet, but you could. And then all of a sudden another company in the same industry as you gets their bond directors to approve 6% bonds. Well, now a bond investor, a bondholder, has the option of buying your bonds, which pay 5% interest, or the bonds of your competitor, which pay 6% interest. And why would they want to pay for your bonds only getting 5% interest when they could go to another company that's equally as risky to them and get 6% instead? So the stated rates on the bonds that you have had authorized isn't always going to be equal to the going market rate of those bonds, which means if you have a time where your rate is worse than the going rate in the market, you have to entice bondholders to want to invest into your bonds. And the way that you do that is by selling them to the bond holders for a price less than the face value of the bond, and that is called a discount on bonds payable. Inversely, you may have a time where you have bonds that are authorized at a rate of 6, 7, 8%, we'll say 6%, and everybody else that's in a similar industry as you is only paying 5%. Well, now your bonds are better. They have a higher rate of interest, and you're not going to give away, something for nothing. So people are going to want your bonds because they're paying more interest. How do you maximize your cash flow with these better bonds? Well, you charge a premium. You charge those people more than the face value of the bonds. And here it is in graphic form. But the rule of thumb on the bottom is that if the stated rate of interest on your bond is equal to the market rate of interest, you issue those bonds at face value. So a 9% $1,000 bond in a 9% market should be issued for $1,000. If the stated rate of interest on your bond is less than the market value, well, no one would reasonably invest in your bond at the same price if they could just go and get a better interest rate elsewhere. So to entice investors to buy, you have to offer them at a discount. So a $1,000 9% bond in a 10% market has to be sold for less than $1,000. If the stated rate on your bond is greater than the going rate in the market, however, people are going to want your bonds more. So you should charge a premium. So a $1,000 9% bond in an 8% market should be sold for more than $1,000. A question I frequently get asked is why companies even bother with bonds when they could just issue stock instead. I mean, issuing bonds requires you to make a huge repayment of a liability down the road. And if they issue stock, well, they get money for selling a portion of their corporation. The only payments they have to make down the road are that series of dividend payments. I mean, that's just cheaper for the company. Why would they do that? And the answer to that is twofold. Firstly, if you continue to issue stock and issue stock and issue stock, you're going to be watering down each person's ownership of the company. And since we know profits are spread evenly amongst all owners, that means it's going to decrease the amount of money that each existing stockholder gets anytime that you pay dividends. And that doesn't make your existing stockholders happy. So if you continue to keep issuing stock, well, you're probably going to drive down the market price of your stock, which no company ever wants. The other benefit of issuing bonds is that they are tax deductible. The interest on bonds is subtracted from a corporation's taxable income, therefore lowering their tax liability. So companies, if they could get away with it, would always issue bonds because it's cheaper for them. The problem with that is they put too much liability on their books if they did that. And then they would have a ton of liability sitting there that when they release their numbers, their investors get to see. They would be scared off by the fact that the company owes so much money. They might sell their shares of that company, therefore driving the company's stock price down. So issuing bonds and issuing stock both are perfectly viable ways of raising money for your company. And as a company, you would always issue bonds because you get the tax benefits of it. But you can't, because if you did and you took on too much liability to be able to handle, well, you may miss a bond payment, at which case you're going to default on those bonds. Everybody's going to know about it, and people are going to start selling your stock off. It's going to drive your stock price down.